Hi students. So in the previous class we discussed the basics of an accounting, nothing but what is meant by transactions and event, and what are the types of the transaction. Nothing but transactions are of two types, nothing but monetary transactions and non-monetary transaction. So simply I'm giving the briefing about the previous class. First, transaction is nothing but an exchange made between business and outsider is said to be a transaction. And those transactions are classified into two types. One is monetary, another one is non-monetary. So monetary transaction is nothing but the transactions which are measured in terms of money or monies, both are called as monetary transaction. And the remaining are covered under non-monetary. Again, monetary transactions are classified into two types. One is cash, another one is credit. So in case of cash transaction, the transaction which involves the immediate payment or immediate receipt of cash is called as cash transaction. In case of credit transaction, the payment or receipt of the cash is postponed. As per money measurement concept, both cash and credit transactions are recorded in the books of account. And next coming to the event. Event is nothing but the consequences or end result of all transactions is said to be a what? Event. Only closing stock and profit or loss. So these are covered under the definition of what? Event. And next coming to we discussed what is meant by an accounting. Generally, accounting consisting of six stages. One is recording, classifying, summarizing, analyzing, interpreting, and communicating. And the later we discussed what is meant by users. Users are nothing but the persons whose decisions are affected by the decisions of the management. And simply said, the persons who are using the financial information of the entity called as users. And those are classified into two types. One is internal, another one is external. And the later, and we discussed objectives of an accounting. So, and it means so systematic recording of transactions and events. And second one is to ascertain the financial position. And third one is to ascertain financial result. And fourth one is for complying with all statutory requirement. And the fifth one is for calculation of the liquidity and solvency ratio. So these accounting is used. And next subfields of an accounting we discussed. So nothing but five subfields are there. Financial accounting, cost accounting, management accounting, human resource accounting, social responsibility accounting. So these what we discussed in previous class, and some definitions also we discussed. So relating to the capital, drawings, assets, liabilities. So these are we discussed in the previous class. Okay. And in this session, we are going to deal with completely about the bookkeeping. And before that, some small definitions are there. First, we complete those definitions. So the first one is, okay. So the first one is, what is meant by debit and what is meant by credit? What is meant by debit and what is meant by debit? Generally, debit is the word, it is taken from the Latin word called as a debire. It stands for O from the third party. O from the third party and is represented with the word dr, and O to the third party and is represented with word here. Any amount receivable from the third party or anything receivable from the third party is called as a debit, or anything payable to the third party. Actually, always remember you have to think from the point of view of the business only, not from the point of view of any another. So amount O from the third party to the business is called as a debit. Amount O to the third party by the business is called as credit. Is called as credit. And another one is account. Actually, in the previous class discussion, we are discussing what is one by classification. In case of classification, what we do, so the similar nature of transactions relating to the particular item are combined together and mentioned at one place, and that statement is technically called as what? Account. That is called as what? Account. So generally, account is nothing but it is a T-shaped format. It is a T-shaped format. So consisting of two sides. Left hand side is called as a debit side and the right hand side is called as a credit side. And the left hand side at the corner we have to mention what DR, and in the right hand side and at the corner we have to mention what CR. And each side it consisting of four similar columns. One is date, particulars, JF number, amount rupees. Same way on the credit side, date, particulars, JF number, and amount rupees. So in this way, so each side four similar columns are there. In total, 8 columns are there in the ledger, in the account. So account is nothing but it is a T-shaped format and consisting of two sides. The left hand side is called as the debit side and the right hand side is called as what credit side. And each side it consisting of four columns. One is the date, particulars, JF. JF stands for journal folio number. And amount rupee. Date, particulars, JF number and amount rupee. And here at the middle we have to mention the name of the account, a title of the account. For example, here in this account we are writing the total details about the capital. Then we have to use the word capital account. So A/C is nothing but what account. For example, in case we are writing the salary details, then salary account we have to mention at the top. And in case of goods, sorry, in case of purchases, we have to use what purchases account. In case of sales, sales account. In case of furniture and fixtures account. Plant and machinery account. The name of the account we have to mention at the middle and at the top of the respected account. So this is the format of the account. Okay. Next, coming to the bookkeeping. So bookkeeping is nothing but the art of recording the transactions and events in a systematic manner. The art of recording the transactions and events in a systematic manner is called as what bookkeeping. Is called as what bookkeeping. So here the recording includes two stages generally. One is the journal and another one is the ledger. And journal is covered under recording stage of an accounting. Ledger is covered under classification. And along with this, so it also consisting of the preparation of trial balance. And that means bookkeeping covers only the clerical work. So it covers only the recording phase of the transactions and events. So generally, only two books we are maintaining in the regular practice, nothing relating to the business. One is the journal, another one is a ledger. And after identification of the transactions and events, we record first in the journal, and then later the transactions and events are transferred to the ledger, to the journal. And those are covered under these pages, recording, classification, and the summary statement of the all accounts maintained in the ledger are mentioned in a separate statement called as what trial balance. Okay, the art of recording the transactions and events in a systematic manner. What is meant by systematic manner? In case of the journal, we call it as chronological order. And in case of the ledger, we call it as analytical order. We call it as analytical order. So what we those things already we discussed in previous class. So chronological order means as and when the transactions incur, those are recorded immediately, nothing but on date wise. In case of analytical order, we are analyzing the transactions recorded in the journal. So, means similar nature of transactions are combined together and put at one place to know the impact of all transactions relating to the particular item. That's why we call it as analytical order. Analytical order. This is what is meant by bookkeeping. Bookkeeping stands for the art of recording the transactions and events in a systematic manner. The art of recording transactions and events in a systematic manner is called as bookkeeping. And the bookkeeping consisting of three stages. One is the recording, another one is a classification, and another one is preparation of the trial balance. And here the systematic manner is nothing but we have to record the transactions in chronological order in case of journal, and analytical order in case of ledger. In case of ledger. And bookkeeping covers simply a clerical work. So clerical work of the accounting, clerical work of the accountant, those are only covered under the bookkeeping. Okay. Then coming to the next one, what is the objectives of the bookkeeping? So the main objective of the bookkeeping is nothing but recording the transactions and events in a systematic manner. And second one is ascertaining the effect of similar nature of the transactions on the position of the entity. And here, one point covers the recording, nothing but journal. Another point covers what ledger. So the main object, as we discussed, so first we have to identify the transactions and events, and the later we have to record those transactions and events in journal, and the later we transfer the transactions and events from the journal to the ledger. So the main objective covers the process of recording the transactions and events in a systematic manner and ascertaining the impact of similar nature of transactions on the position of the entity. So means so for example, all capital related transactions are combined together and mentioned at one place called as capital account. All salary related transactions are combined together and mentioned at one place called as salaries account. And in this way, similar nature of transactions are combined together and we ascertaining the net impact of all those transactions on the entity. And that is also one of the objective of the bookkeeping. Okay. And before going to the types of the bookkeeping, first of all, what is the difference between bookkeeping and accounting? What is the difference between bookkeeping and accounting? So generally, bookkeeping is nothing but the art of recording the transactions in a systematic manner is called as what bookkeeping. But accounting covers it is an art of recording, classifying, summarizing, analyzing, interpreting, communicating, results thereof relating to financial transactions. Financial transactions stands for what? Only monetary transactions are considered. Only monetary transaction. And as we discussed, bookkeeping covers only the clerical work of the accountant. And it means the managerial decisions are not possible here. But here, managerial decisions are possible. Generally, accounting is done by the professionals. And another thing, the financial statements are forming part of are not forming part of bookkeeping. And here the financial statements or sorry, financial statements are forming part of the accounting. So, and in case of bookkeeping, the end result, bookkeeping is the trial balance. The final output of the bookkeeping is nothing but what? Trial balance. But in case of accounting, the final output is financial statements of the entity. The final output is nothing but the financial statements of the entity is nothing but what? Accounting. Okay. So these are the main objectives or main differences between the bookkeeping and accounting. Bookkeeping and accounting. Okay. And you may write another some more differences. For example, in case of bookkeeping, there is no subfields. In case of an accounting, we have these subfields. So five subfields are there as we discussed: financial accounting, cost accounting, and management accounting, and human resource accounting and social responsibility accounting. All are covered under the accounting subfields. Okay. So these are all the main objectives of bookkeeping and accounting. Okay. And next, coming to the bookkeeping. Bookkeeping is how the bookkeeping is done. Generally, bookkeeping is done in two ways. One is the single entry system. Another one is the double entry system. Single entry system and the double entry system. Generally, single entry system is used where the business is unable to maintain the full information relating to the accounting. So some parties are there. For example, if you consider a small chapel shop or if you consider small pachari shop, and those parties are unable to maintain the total records related to the entity because maintenance of the full information will result in some cost, and that cost unable to bear by the parties because they need to appoint one professional and they have to incur some administration cost. So for maintaining that books of account, but that is not possible and that is not bearable by the respected party. So they maintain only few transactions which are required by the respected party. In that case, in case of incomplete records, accounting is done by single entry system. So single entry system is the best method for accounting of incomplete records. And the double entry system is the best method for accounting of complete records. And single entry system, we discuss it in later classes. Then first we'll close the double entry system. And what the double entry system says. As the name said, double entry system, every transaction is having two aspects, that is the debit aspect and the credit aspect. So every transaction is having the two aspects. One is the debit aspect and another one is the credit aspect. And those are also considered as, one is the receiving aspect and another one is the, sorry, giving aspect. Another one is the giving aspect. So based on this rule only, double entry system was framed, and it was found by Luca F. Pacioli, and we consider him as a father of the accounts. So double entry system is the best method for accounting of complete records, and this is defined as this is described as every transaction is having the two aspects, that is a debit aspect and another one is a credit aspect, that is nothing but receiving aspect and giving aspect. Actually, this is framed based on one of the most so important concept called as a dual aspect concept. Dual aspect concept. For example, we purchase the goods. So we purchase the goods. There, the receiving aspect is nothing but what goods, and the giving aspect is nothing but what cash. And we pay the salaries to the employees. The receiving aspect is nothing but service, and the giving aspect is nothing but what cash. And we pay the rent to the landlord. The receiving aspect is nothing but service. Giving aspect is nothing but what cash. And sale of an asset. Receiving aspect is nothing but cash. Giving aspect is nothing but what asset. So if every transaction you identified, so it consisting of two aspects. One is the receiving aspect, another one is the giving aspect. But among that receiving and giving aspect, we have to identify what is the debit aspect and what is the credit aspect. So what is the debit aspect and what is the credit aspect? And for identifying that debit and credit aspect, two approaches are framed. One is the traditional approach and another one is modern or accounting equation approach. Okay, so bookkeeping is nothing but the systematic recording of transactions and events, and it is done in two ways. One is single entry system, another one is a double entry system. And the single entry system is the best method for accounting of incomplete record, but the double entry system is the best method for complete record. And the double entry system is described as every transaction is having two aspects. One is the receiving aspect, another one is giving aspect. And that receiving and giving aspects are identified by using any one of the two approaches. One is the traditional approach, and another one is what? Modern approach or accounting equation approach. Then we'll define what is how the accounts are classified under traditional approach and how the accounts are classified under modern approach. So coming to the traditional approach. As per traditional approach, as per traditional approach, all accounts are classified into three types. All accounts are classified into three types. One is the personal accounts and the real account, nominal accounts. Personal accounts, real accounts, and nominal accounts. Personal accounts consisting of all persons who dealing with business. All persons dealing with business is covered under definition of a personal account. Nothing but owner and nothing but creditor and debtor, Rama, Sita, A, B, C, and every person who is dealing with the business in relation to the trading concern, in relation to the trading, or in relation to the day-to-day operations of the entity, all are covered under personal account. And these personal accounts are again classified into the three types. Again classified into the three types. One is the natural persons, and another one is artificial persons, and another one is representative persons. Natural persons, artificial persons, and a representative person. Natural persons are consisting of all human beings. All human beings are covered under natural persons like Rama account, Sita account, Abhi account, Bhargav account, Gopi account. So every person, every human being dealing with business are covered under natural persons. And artificial persons are covering what legal persons. And it means these are created and their exit is operated by provisions of the law. So if you wanted to call that person, they need to get the registration under the provisions of any law for time being enforced. For example, company. Company is getting the registration under Companies Act 2013. So that is an artificial person. And partnership firm. It is getting the registration under the provisions of Partnership Act. So that is an artificial person. And charitable trust and cooperative society and even government also get the registration as per the Indian constitution. That is said to be an artificial person. Every person who are created and whose exit is done by operation of provisions of any law for time being enforced are covered under artificial persons. And coming to the another one, representative person. Actually, these representative persons are nothing but those are not the personal accounts. Those are not the personal accounts, but representing a group of people to whom the amount is payable or from whom amount is receivable. So it is not a personal account, but representing what a group of people to whom the amount is payable or from whom the amount is receivable is called as a representative person. For example, salaries are there. Generally, we have a policy of paying the salary on the 10th of every month, 10th of the next month. For example, January month we paid on or before 10th of February. February month rent salary we paid on or before 10th of March. March month rent we paid on or before 10th of April. But actually we are closing the books of accounts on 31st March of the every year. But on 31st March, actually we are liable to pay the salary, but we didn't pay because as per the policy we are paying the on or before 10th of the next month. So if we have to create one account, we have to create one account. So that is representing what amount payable to the group of employees, and that is nothing but what salary payable account, salary payable account. So actually there is a relation between representative person and a nominal account. And before that, I will explain what is meant by nominal account. Nominal accounts are simply, those are called as a temporary accounts. Why we call those accounts as temporary accounts means those are created and closed in the same year, same period. So we created in the current year and those are closed in the current year. Those accounts will not continue to the next year or subsequent years. And that's why we call them as a temporary accounts. And it consisting of all expenses and losses and all incomes and gains. All expenses and losses and all incomes and gains are covered under what? Nominal account, like salaries account, rent account, printing and stationery account, traveling expenses account, transportation expenses, freight account, carriage account. So these telephone expenses, electricity bill expenses, all are covered under what? Nominal account. There is a relation between personal, representative personal and nominal account, and means that is explained as, for example, salaries account is a nominal account, but salaries payable is a representative personal account. And outstanding salaries are representative personal. Prepaid salaries account is also representative person. And simply is nothing but in case of a nominal account, in case of nominal account, any prefix or any suffix added that become what? Representative personal account. So because salary payable is representing the group of employees to whom the amount is payable. So, and the outstanding salaries also like that. So prepaid salaries are nothing but a group of employees to whom the salary paid in advance. So from whom we are going to receive the services in future. So these are all what? Representative person. Actually, it is not a personal account, but representing a group of people to whom the amount is payable, to whom from whom the amount is receivable. So why don't we open the personal accounts, individual names? Why don't we open the accounts in the name of individual names of the employees or individual names of the landlord? Actually, there is a rule. As we discussed, a nominal account is a temporary account. So as it is a temporary account, the total transaction or exchange already over. For example, coming to the rent, we utilize the building and we pay the rent. Coming to the employees, we get the services and we pay the salary. The transaction is over there. So no need to continue that person in the business, and means that name of that account is not required to continue. So we have to consider only the service provided by the party. That's why everywhere we are using the name of the service in terms of like rent, salaries, interest, so printing and stationery, traveling, etc. Nowhere we use the name of the person. So employee names and landlord names are not used anywhere. That is the basic rule. Okay. So this is what is meant by personal account and what is meant by nominal account. And coming to the another one, real account. Real account consisting of all tangible and intangible assets of the entity, but not the debts. All tangible and intangible assets of the entity are covered under what? Real account. So tangible assets are nothing but those assets which can be seen and which can be touched are called as tangible assets. And intangible assets are nothing but those assets which cannot be seen and which cannot be touched are covered under intangible asset. The best example is, for example, furniture and fitting is a tangible, building tangible, land tangible, and for example, goodwill is a intangible, patent, copyright, trademark. These are all what? Intangible assets. Intangible assets cannot be seen. Those are available only in documentary format. Okay. And as we said, real account does not consisting of debts. Borrowings are not covered anywhere under real account. So borrowings are covered only under personal account, not covered under real account. Okay. So these are the classification of the accounts as per what traditional approach. So all accounts are classified into three types. So one is personal account, another one is real account, another one is nominal account. This is the classification provided as per traditional approach. Then coming to the next one, what are the golden rules of an accounting? Actually, as we discussed previously, so for identifying the debit and credit aspects relating to a transaction, we have the two approaches. So how to identify? So based on these rules. So we have three accounts, right? One is personal account and a real account and a nominal account. What is the debit rule and what is the credit rule? And some persons are saying what is meant by debit. Based on these rules, they are defining what is meant by debit and what is meant by credit. But that is wrong. Debit stands for O from the third party to the business. Credit stands for O to the third party by the business. Here, debit stands. What is the debit in case of a personal account? So, in case of personal account, receiver account is a debited, giver account is credited. Debit the receiver, credit the giver. In case of real account, what comes in is a debited and what goes out is credited. In case of nominal account, all expenses and losses, all incomes and gains are credited. How to read these rules? In case of personal account, debit the receiver, credit the giver. In case of real account, debit what comes in, credit what goes out. In case of nominal account, debit all expenses and losses, credit all incomes and gains. And these are the basic rules which are used for writing, for identifying the debit and credit aspect. For identifying the debit and credit aspect, right? So for example, in case of purchase of goods for rupees 2 lakh, here the receiving aspect and giving aspect is the receiving aspect is nothing but what goods. We purchase the goods, we receive the goods. So goods is a asset. That is a real account. What is the rule for real account? What comes in is a debited and what goes out is credited. Here goods or comes into the business. So comes in is debited. And giving aspect is nothing but we are paying what cash. Cash is also a real account because it is a tangible asset. It is a real account. Real account, what is the rule for real account? Comes in is debited, goes out is credited. So here cash goes out of the business. So that account is credited. That account is credited. And another example, salary is paid to the employees rupees 1 lakh. We pay the salaries. So here, what is the receiving aspect and what is the giving aspect? So receiving aspect is nothing but why we are paying salaries to the employees because they are providing the service. We are receiving the services. We are receiving the services. So services are always mentioned. All expenses and incomes are mentioned in terms of goods and services. So any amount any amount is spent for receiving these services, these are nothing but what expense. And it is represented with the name of that service. What we are paying here? Salary. Salary. Salary is a nominal account. And what is the rule for nominal account? All expenses and losses are debited and all incomes and gains are credited. So as it is an expense, that account is debited. And the giving aspect is nothing but we are paying what? Cash. Cash is a real account as it is a tangible in the nature. As per real account, what comes in is debited and what goes out is credited. Here cash goes out of the business, so that account is credited. That account is credited. Okay. And coming to the another one. So rent paid to the landlord, rupees 5 lakhs. So rent paid to the landlord, rupees 5 lakh. Then what is the receiving aspect there? And what is the giving aspect there? Receiving, why we are paying the rent? Because they are providing an access for utilization of the building. Nothing but we are getting what? Services. And the service is represented with the name of the amount you paid. Nothing but what? Rent. So rent is a nominal account. And what is the rule for nominal account? All expenses and losses are debited and all incomes and gains are credited. Here the rent is an expense, so that account is a debited. And the giving aspect is nothing but what? Cash. Cash is a real account. And what is the rule for real account? So debit what comes in, credit what goes out. Here cash goes out of the business, it goes out. So that account is credit. That account is credited. So here, in case of double entry system, the main objective of the double entry system is to record the transactions and events and by identifying the both the debit and credit aspect. And those are identified by using any one of the two approaches as we discussed. One is the traditional approach and another one is a modern approach. As per traditional approach, all accounts are classified into the three types. One is personal account, real account, and nominal account. Rule for personal account is debit the receiver, credit the giver. And the rule for real account is a debit what comes in, credit what goes out. And the rule for nominal account is a debit all expenses and losses, credit all incomes and gains. And these are the golden rules of an accounting. And in every transaction, we have to analyze the transaction before recording it in the journal. So the analysis will be done in this way. What is the receiving aspect and what is the giving aspect? And what is the nature of that account, whether it is personal, real, or nominal, and apply the rule. And based on that, write whether it is debited or credited. Debited is mentioned with dr, credited is mentioned with cr. Okay, so this is what the traditional approach. Okay, and next, coming to the next one, accounting equation approach, and is also called as modern approach. Accounting equation approach or a modern approach. What is meant by accounting equation? How the accounting equation was framed? Generally, accounting equation is framed based on one thing. So nothing but in case if you, for example, if you want to start the business. So if you want to start the business. So for starting the business, for what we have to bring the amount into the business. And how do we bring the amount into the business? If you have the amount in hand, that amount we invested and is it technically called as what? Capital. If the amount is not had in the hand, sufficient amount is not available along with the own fund, nothing but capital, and you borrow the amount from the outside. So that is nothing but what? Liability. So borrowing fund is called as what? Liabilities. And we bring the amount. And that amount is utilized by the business. For what purpose we are utilizing the business? One is for purchase of the assets if any required. And another one is for meeting the payment of expenses incurred in the day-to-day operations of the entity. And after utilization of the amount we are doing while we are doing the business, so we are earning certain amount. We technically called as income, and that income is not taken by the owner and go out of the business, and he is again reinvesting that amount into the business. That's why income is also covered under one of the source. So these all are covered under sources of the finance, and these are all called as what? Application of the funds available. So how can we write? The total sources of the finance equal to total application of the funds. Sources of the finance is here is nothing but what? Capital plus liabilities plus income. Applications are nothing but what? Assets and expenses. And this is called as what? Accounting equation. Accounting equation. So as per accounting equation, so all accounts are classified into the five types. All accounts are classified into the five types. One is capital, liabilities, income, assets, and the expenses. Capital, liabilities, income, assets, and expenses. So the sources of the finance consisting of three things. One, a capital, liability, and income. And application of the funds is done in two cases, or two ways. One is assets and payment of what? Expenses. And these are the five categories we have as per accounting equation approach. And as we discussed, generally the difference between income minus expense is it technically called as what? Either profit or loss. The difference between income or expenses is called as profit or loss, and the profit or loss is a transfer to what? Capital. And it means profit or loss relating to the business are generally belongs to the owner, and the owner represented account is there is nothing but what? Capital. Means you can simplify the respected accounting equation, and is the simplified equation is called as capital plus liabilities is equal to assets. This is the simplified accounting equation, and the format of the accounting equation is in the form of the balance sheet. That's why we also call it as balance sheet equation. We also call it as what? Balance sheet equation. Capital plus liability is equal to asset. But the original accounting equation is nothing but what? Capital plus liability plus income is equal to what? Assets plus expenses. That is the original accounting equation. And the net accounting equation or balance sheet equation is nothing but capital plus liabilities is equal to what? Assets. Capital plus liabilities is equal to what? Assets. And this is an accounting equation. As per this approach, all accounts are classified into the five types: capital, liabilities, income, assets and expenses. Assets and expenses. Okay. And actually this approach is framed based on the famous concept called as dual aspect concept. dual aspect concept. And what the concept says, if there is an increase in asset, the corresponding decrease in another asset is there, or corresponding increase in either liability or capital. So if there is an increase in capital, the corresponding increase in asset is there, and corresponding decrease in another liability. So every transaction has two aspects. One is the receiving aspect, another one is the giving aspect. And based on that only this approach is framed. Okay. So, and what are the rules stated by this approach? Rules. In case of capital, liabilities, income, assets and expenses. Assets and expenses. So here, how the rule is stated. What is the debit rule and what is the credit rule? And before going to that, among these five, again classified into two types. One is the debit item and another one is credit item. What is the meaning of the debit? Amount O amount O from the third party is called as what debit. And that amount O from the third party may be in terms of cash or in terms of service or in terms of asset. What we are going to receive in the future, that will be debited. What we are going to pay in the future, that will be credited. So here, in case of capital, liabilities and the income, capital is nothing but amount payable to the owner in the future. It representing amount given by the owner. As per entity concept, owner is always separated from the business. So business is required to make the payment of the owner amount in the future. So, and the liabilities, as we discussed, that is a borrowing. We have to pay that amount in the future. So these are covered under what? Credit. And income is also belongs to the owner. And that is a temporary capital reinvested by the owner into the business. That's why income is also treated as what? Credit. And assets are providing benefits to the entity in future. Expenses are providing services to the entity. So that's why these two are considered as what? Debit. These two are considered as what? Debit. So always remember, capital, liabilities, income are covered under the credit, and assets and the expenses are covered under what? Debit. And what is the rule for capital? Increase in capital is credited, decrease in capital is debited. Increase in capital is credited, decrease in capital is debited. And increase in liability is debited, decrease in liability is credited, and increase in income is credited, decrease in income is debited. So simply said, the credit items related rules are nothing but increase in credit item is credited, decrease in credit item is debited. So here credit item consisting of capital, liability, income. If these three increases, those are credited. If these three decreases, those are debited. Coming to the debit item, increase in debit item, nothing but increase in asset is a debited, decrease in asset is a credited. Increase in asset is a debited, and decrease in asset is a credited, and increase in expense is a debited, decrease in expense is a credited. Decrease in expense is a credited. And these are the rules relating to the accounting equation approach. Accounting equation approach. And based on that also, we can identify the debit and the credit aspects. So how can we identify some? So for example, so purchase of the goods for 2 lakhs. Here, what is the receiving aspect and what is the giving aspect there? The receiving aspect is nothing but what? Goods. and the giving aspect is nothing but what? Cash. Good is a nothing but what? Asset. If you receive the good, the assets are what? Increased. So increase in asset is a debited. Increase in asset is a debited. Cash is also nothing but what? Asset. We are paying the asset. We are paying the cash. As we paying the cash, the balance of the cash is decreases. Then asset is also decreases. So that account is credited. That account is credited. Next. For example, salaries paid to the employees. Rupees 1 lakh. And what is the receiving aspect and what is the giving aspect? The receiving aspect is nothing but what? Salaries. And nothing but actually salaries are nothing but what? Services. That services are represented with what? Salaries. As we paying the salary, our expenses, it is salaries is nothing but what? Expense. Here expenses increases or decreases. We are paying the salary, so expenses increases. So increase in expenses are debited. And the giving aspect is nothing but what? Cash. Cash is nothing but what? Asset. As we are paying the cash, our cash balance decreases. So asset decreases. So that is a credit. That is a credited. So in this way, we can analyze the transactions either from the point of view of a traditional approach or from the point of view of modern approach or accounting equation approach. Accounting equation approach. And one more thing is, in this case, so we can analyze the transaction in terms of accounting equation also. So we have the examples like this. For example, rent paid to the landlord, 5 lakhs. So what is the accounting equation approach? Capital plus liability income is equal to what? Assets plus expenses. So we are paying what? Rent. If the rent paid, then expenses are increases. Expenses are increased by 5 lakhs. And we are paying what? Salary, cash. We are paying what? Cash. As the cash goes out, cash balance decreases, then asset is decreased by 5 lakhs. Asset is decreased by 5 lakh. And the capital is not affected, liability is not affected, income is not affected. This is an accounting equation. Or you may write in simplified form of accounting equation like capital plus liabilities is equal to what? Assets. Capital plus liability is equal to what? Assets. So here we are paying the rent. If you make the payment of rent, that leads to what? That is what? An expense. Expense is a profit or loss to the business. Nothing but what? That is a loss. If the loss or profit is a transfer to the capital, if you transfer the profit to the capital, then owner fund is increases. But if the loss is a transfer to the capital, then owner fund is decreases. Correct? So loss here, rent is a loss to the business. That is an expense. The expense results in what? Loss to the business. So capital is a decreased by 5 lakhs and cash is also decreased by 5 lakh because cash goes out of the business. So liabilities are not affected. This is an accounting equation. So every transaction should be represented in the accounting equation format as per accounting equation approach. As per accounting equation approach. And another example. For example, rent for the year 5 lakh, but we paid only 2 lakh. but we paid only 2 lakh. We have to represent this one in the net accounting equation format, nothing but capital plus liability equal to assets. How to represent it in the form of capital plus liability equal to asset? Actually, what is the total rent for the year? Total rent for the year is how much? 5 lakhs. So, as we discussed, the total rent 5 lakh is nothing but expense to the business. Because we already utilized the total building. Out of that, how much amount you paid, how much amount not yet paid, that is the secondary matter. We receive the services completely. We are utilizing the building completely for the year. So, that is an expense. Expense leads to loss to the entity and the loss leads to decrease in capital. So 5 lakh decreases. Capital is decreased by 5 lakh. But out of that, how much amount we paid? How much amount we paid? Only 2 lakh. Means cash goes out only 2 lakh. Cash balance decreased by 2 lakh. So asset is decreased by 2 lakh. And the remaining amount we are not yet paid. Means what? We liable to pay in the future. So out of the 5 lakh, we paid only 2 lakh. The remaining 3 lakh we not yet paid. So because of that, so the payable balance increases. The payable balance is nothing but what? Liability. So liability is increased by 3 lakh. This is the accounting equation. Minus 5 lakh plus 3 lakh is equal to minus 2 lakh. So every transaction can be presented in the format. Capital plus liability is equal to asset, and based on that, we can write the transaction in the form of entry in future. Okay. So at the end of the class, we discussed two things majorly. One is traditional approach, another one is modern approach. As per the traditional approach, we classify all accounts into the three types. One is personal account, real account, and nominal account. As per the modern approach, we classified into five types: assets, liability, capital, income, and expenses. Okay. So, and what are the rules we discussed? Okay. And how to frame the accounting equation already we discussed, and how to analyze the transactions also we discussed. And I will explain some more examples for framing the accounting equation. How to frame the transaction in the form of accounting equation, and how to analyze the transactions. So, and I will explain it again in the next session also. Okay. Thank you.